Greetings. Today is Monday, July 1st, 2024. And if you watched our video from last week, you know that in today's monthly market monologue, I'm going to spend a little bit extra time going deeper and looking at the economics to try to answer the question about whether or not we are actually already in a recession. However, before we begin, I would be remiss if I didn't remind you to please hit that like button on the video if you find this content helpful. If you haven't already, please do subscribe, and we would love it if you would leave us a comment. If you want to learn more about the firm, you can go to Hicks-Associates.com. That said, let's go ahead and dive in. We're going to start today by looking at the seasonality chart that's on the screen right now. This is the average performance for the S&P 500 since 1950. However, remember that the S&P 500, as calculated here in this seasonality chart, it is cap weighted. So you can see that the average month of June is a pretty weak month. However, this June 2024 was fantastic according to historical standards. However, the reality is that for the second quarter of this year, about 80% of the S&P 500's return has come from 5 stocks. On the screen, this is the month of June, a good month for the S&P 500. However, if we look at the equal weight version of the S&P 500, you cannot say the same. For the equal weight, the average stock was actually negative in the month of June. So the theme that we have been witnessing for quite a few months now continues. There's just not a lot of breadth in the overall stock market. Now, when we see that, that is typically a warning sign. It is not a signal, it is just a warning sign for us to be careful and cautious. So in particular, one of the things we're going to look at again today is whether or not we're actually already in recession. We'll come to that in just a minute, but quickly, let's show you what the NASDAQ did. Another great month for the NASDAQ, which again is cap weighted. The Russell 3000, again, also cap weighted, but this is a broader measure of the US stock market. The Russell 3000 in the top pane, and in the bottom pane is I have the advanced decline line for the Russell 3000, and you can see that I've drawn this red trend line, which is showing you that recently that trend has broken. That is some encouraging news, and that is one of the things that we really want to get across in today's video, that some of the commentary is not intended to be pessimistic. I'm not trying to be optimistic nor pessimistic. I try to be realistic. And so I'm showing you some pretty big warning signs today, but that doesn't spell doom necessarily. So this is calling it like I see it. This is a good news. So again, the advanced decline line is simply taking the advancing stocks and minusing the declining stocks, and you get a line. If that line is pointing down, that's telling you that more stocks are declining than are advancing. That's not a good sign. We have seen that since May, that the trend there has been down. However, that trend began to change here recently. It remains to be seen as to whether or not that is going to hold, but for now, I'm putting this in the good news camp. Next up, we'll take a look at the seasonality chart for the S&P 600, the small cap 600, and you can see that the average month of June is okay, but June 2024 for the small cap sector was not good at all. That's all we're going to cover today for the stock market. I really want to spend the majority of our time today talking about some of the economic metrics. And so that's what we're going to take a look at next and just try to answer the question, are we already in a recession? So let's go there now. So in last week's video, we talked about the Schannep Recession Indicator, which is suggesting that a recession has already started or it's about to get started. And that is the reason, other than the fact that it's the midpoint of the year, that's the reason why we want to spend a little extra time right now looking at the economic data to determine whether or not that Schannep Recession Indicator is accurate. And if you recall, that indicator uses the unemployment rate. That unemployment rate is on the screen right now. We talked about this on last week's video, how the unemployment rate has definitely risen lately, and we're going to come back to that in a second, but this unemployment rate figure goes into this Schannep Recession Indicator, and if you recall, this indicator suggests a recession has started or is about to start every time we cross the 0.4% mark. And that has happened every single time right before a recession starts. So that's the reason we're looking at this now. Is there enough evidence to back up this Schannep Recession Indicator? If you know us, if you know the work that we do not put a lot of weight in any one thing. We believe in the weight of the evidence. So yes, this is an indicator that is suggesting the recession is starting. But what is the weight of the evidence? Not just one data point. What does the weight of the evidence suggest? So that's what we're going to look at. Now, that said, one of the other indicators that has been suggesting a recession is the yield curve. The yield curve has been inverted for about 18 or 19 months now. That again suggests a recession. So far, both the Schannep Recession Indicator as well as the yield curve, so far, these two indicators do have perfect batting averages. They have perfect records. Now, if you go back to the Schannep Recession Indicator, you can see that this one is pretty tight. Every time it crosses that 0.4 line at the bottom, a recession starts. The same cannot be said for the yield curve. And this is something that we have talked about for, I don't know, more than a year now, because if you look at the data, there is not a very strong correlation in terms of timing. You can't say the yield curve is inverted, therefore recession starts next month. There is sometimes a quite significant lag between when the yield curve inverts and when a recession starts. If you look at right before the dot-com crisis, the recession or the yield curve first inverted 30 months prior to the onset of the dot-com crisis. And then before the global financial crisis, it was inverted for almost 2 years before we actually had a recession. So yes, the yield curve does have a perfect batting average, but we've not been able to use it as a timing device for any serious decision making because of the lag. There's always a possibility that one of these indicators that has always been true before fails this time. That's happened plenty of times. So now on the screen we have the Atlanta Federal Reserve's GDP Now tool. Their GDP forecast, as you recall, was forecasting about a 2.2% growth rate for the economy in the second quarter. And if that happens, if that's true, here's your updated histogram. So remember, historically, we have defined a recession as 2 consecutive quarters of negative GDP. Now, we need to talk a little bit further about that because, again, right here in 2022, we did have 2 quarters of negative GDP, but for whatever reason, the National Bureau of Economic Research did not mark that time period as a recession. So if the Atlanta Federal Reserve's GDP Now tool is accurate, then we can't be in a recession just yet, but is one coming? That's what we're looking at today. So back on February 20th of this year, I gave an economic webinar to a local organization, and I used a scoreboard to help tally whether or not we see a recession coming or not. On the screen right now are the data points that went into the scoreboard, and you can see very easily that the majority of the data was suggesting that it is not yet recessionary. Well, at the time, I was unaware of the Schannep Recession Indicator. However, if we were to include the Schannep Recession Indicator on that scoreboard, this is how the scoreboard would look because, again, at that time, the Schannep Recession Indicator was not yet recessionary. So we're going to use this as a data point to determine where are we at now. Now, that said, we've already talked about 2 of those data points, so we're going to put the Schannep Recession Indicator and the yield curve in this recessionary column. Now, we're going to start picking up the pace as I go through the items that are going to be added to this scoreboard simply because of the length of the video. Next up is durable goods. When we look at the durable goods chart, we definitely see a little bit of a correction, but the trend has picked back up. So I'm going to put that into the not yet recessionary category. Next up, we have building permits. I'm going to show you both building permits and housing starts, and both of these 2 charts do not look good. They are clearly struggling. In particular, if you look at housing starts, we're putting in new lows. That is not a good sign. Now, when we talk about the broader economy, it's really not a good sign because according to the National Association of Home Builders, housing generally contributes about 15 to 18% of GDP. So the fact that housing is struggling like it is not a good sign at all. So I am indeed putting that data point into the recessionary category. Next up is manufacturing new orders, and I am putting that into the not yet recessionary. Stock market, we've talked a little bit about that. You can't say the stock market is recessionary when the main indices are hitting all-time highs. Yes, the equal weight versions, the equal weight S&P 500 is struggling a bit more. and we don't have a ton of market breadth, but that's not yet recessionary in my book, but obviously something that we watch. Consumer sentiment, this is the University of Michigan Consumer Sentiment Survey, and I am putting that in the inconclusive category. It has definitely spiked down, but it certainly has come off of those extreme lows. So I'm putting that in the inconclusive category. Next up is a credit sub-index, and this is from the Chicago Federal Reserve. And in particular, if you look at the gray bars, as we go into a recession, the credit sub-index spikes above the zero line. That is not the case here. We continue to be below the zero line, so that is not yet recessionary. Next up is unemployment. We've also already looked at that. I'm going to put that kind of in between the recessionary and not yet recessionary. I say that because it has definitely been ticking higher. However, if you go back to the textbooks have historically categorized our economy as full employment at about 4%. So the fact that our unemployment rate is at 4% right now, I can't say that's recessionary. The fact that it's ticking higher is certainly not encouraging news. And then obviously it is a data input in that recessionary indicator from Mr. Schannep. So I'm putting that kind of in the middle between the two. But when we look at job openings, which is another data point, that is not a good chart. That is, the job openings are definitely coming down. So I put that into the recessionary category. So last data point is Dr. Copper. I'm going to take a little longer to walk through this one. It is said that the price of copper has a PhD in economics because copper has a tendency to go down as we go into recession. And again, on the screen, you can see the gray bar from the 1990 recession. Copper was going down. Dot-com crisis, copper was going down. Global financial crisis, well, everything went down. And again, during COVID, again, everything went down. So, but let's zero in on this chart a little bit. Now on the screen, we have since about 2006 through present day. You can see on the right-hand side of the screen, I put this red bar in here, a red line in here. That was kind of the line in the sand that I was really trying to watch. And it bounced off of that, hitting new all-time highs, but the price has come back in just a little bit. So we've got about a 12% correction right now in the price of copper. And so while you could certainly say that that is recessionary, I'm not going into that camp. The other thing that I wanted to use this as an example is to go back and talk about the National Bureau of Economic Research. They are the folks who have become the official arbiters of when a recession starts and stops here in the United States. However, there is another organization called the OECD. They are the Organization for Economic Cooperation and Development. And if I look at their data, look at the additional gray bars that just popped up on the screen. Let me flip that to you for you one more time. The gray bars here, which are pretty light, I apologize, but those are the gray bars from the National Bureau of Economic Research. Looking at the same exact data, you can see that the OECD organization puts 2 additional recessions in our economy in 2012 and 2016. So this is something for us to a longer debate perhaps, but right now I'm going back to the chart. I'm putting Dr. Copper in the inconclusive category. Now, if you recall from the chart that the scoreboard from February of this year, the yield curve was the only thing in the recessionary category. Everything else was not yet recessionary, and I believe I had Dr. Copper as inconclusive. That scoreboard has absolutely changed in the last several months. Now, does this mean that we are rapidly approaching a recession? Is the Schannep Recession Indicator definitively going to maintain its perfect batting average? I'm not ready to declare that. From what I'm looking at right here, we definitely see the economy is weakening. Can we stave off a recession? I think that is still distinctly possible. I'm going to use the stock market as one of our key guides. And if you are a client of ours, this is also a very important point. What I'm trying to do here is provide the data, but I'm not trying to scare anybody into doing this or doing that. That is not what we're doing. Again, if you're a client of ours, we're already actively managing your portfolio. And the number one data point that we use in a stock market portfolio is price. If a position is coming down, we might take action based upon our rules-based methodology. We are not going to take a recession barometer and say, hey, we have to go to cash. We think that is a horrible idea, and we do not think you, or whether you're a client of ours or you're not a client of ours, we don't think you should take this data points and do anything different. This is simply a warning. This is simply a be ready. So that can be impacting your job search criteria. That can be impacting whether or not you want to go buy that brand new car right now. Maybe you want to hold off a little bit longer if the car can last. You're trying to schedule a big vacation or something like that. If a recession is indeed coming, if the warning signs are starting to go off, we might say, well, you might want to hold off on spending decisions. But it does not impact, in our opinion, it does not impact portfolio decisions. Portfolio decisions are made by price. So if you have any questions on that, by all means, feel free to reach out to me. If you have specific questions about how we manage money, if you are looking for a second opinion on your portfolio that needs to be managed, then by all means, feel free to reach out to us. Again, Hicks-Associates.com. You'll see a couple of blue buttons, schedule a call. Feel free to reach out to us. We'd be happy to see if we can't be of service. Until next time, we do hope you find these videos helpful. We certainly ask that you hit that like button and feel free to share the videos with your friends. Again, thanks for watching. We'll talk to you soon.